All right, episode 64. How exciting. This time we're going to look at something that is changing right as we watch, and that is the yield on agency bonds. Let me tell you more. Quick housekeeping. Thank you for new subscribers. You can actually figure out how to navigate the channel by looking for this video called How to Navigate the Channel. How complicated is that? There is also a playlist. Please feel free to use that. That is the most logical way to watch this show instead of picking it up right in between. Having said that, my usual disclaimers, this is not investment advice, it is education. I am not a wealth management advisor. I have no allegiance to any sponsor, and I do not endorse products or politics. Now, let's talk about what we are going to discuss. This time, we're going to look at something that is changing in agency bonds, and it is changing a lot. And before we go there, we'll look at what is it that is changing? Why is it changing? What does that mean to you between now and X day, as it is called, which is the default day if it happens? And what can you do in terms of your portfolio management? And more importantly, what am I doing? And you do what works for you. Well, let's look at the backdrop. There are a couple of agency bonds that I invested in, and they both got called, and that is what alerted me to looking at what is going on. The first was an FHLB bond that was a 5-year duration. It paid a coupon of 6%, and I was very happy to buy it. I said, hey, 6% for 5 years sounds good to me. Got called. And a little bit later, 6.44% 10-year ffcb. And as you can imagine, both of these are spectacular interest rates for long periods of time. The reason why I thought I'd throw some money at it, and they both got called on the very first day they could have been called. And lucky for me, I bought them both at par, and I did get the first coupon payment, but I got paid the par value. So what is it telling you? Well, in all likelihood, the agencies are making the calculation that they don't need to keep offering 1.5% above prevailing rates. They are making the calculation that interest rates aren't really going to go super high, and so they don't need to issue very long duration bonds at that high rates. And so they are calling these, and they are issuing new bonds. And the new bonds are at a much lower rate, and that is what they are learning. They are saying, well, how about I give a 5.5%, 5.8% for 10 years instead of 6.44? You would do that if you were in that agency as well. So what does that mean to you? If you were to look at the 1-year agency bonds, once again, there is something funny that is happening. Even though the longer duration agency bonds are decreasing in yield, very much like treasuries too. Treasuries used to be 4% for 10 years, and now treasuries are 3.4%. So the longer term is decreasing, and the short term treasuries, the 3-month treasuries, are going through the roof. The same thing is happening for agency bonds, except in the 1-year duration. So if you were to buy the 1-year duration right now, you get a really good interest rate compared to even the treasuries. Therefore, what does it mean? Well, let's look at the trend. In all likelihood, if what we are seeing gets continued, if you have agency bonds with a coupon north of 5.75% and with a duration of 5 years or 10 years, they are going to get called because you would do the same. And so what could you do? I always believe in looking at the best of available options and making a decision. So let's review what is there. You could buy CDs, I suppose. In theory, they pay a little bit more than treasuries. However, remember, CDs cannot be cashed right away. You lose interest if you cash it. Liquidity is much lower, and you pay state taxes. So none of these CDs will actually do better than the equivalent treasuries. So CDs are nice, but no cigar. Then we go to the zeros. Even the zeros don't look very attractive. Then we come to agency bonds. And with agency bonds, there is an interesting phenomenon going on. If you bought agency bonds that are 6 and 9 months, you cannot compete with the highly inverted treasuries. However, the best of available options is the 1-year agency bond, currently paying 5.25%. plus state tax. So if you're in Illinois, this is more like 5.6% pre-tax, which is phenomenal. So where does this take us in terms of the default date or the X date, as we call it? Let's look at what the credit rating agencies are saying. The credit rating agencies both affirmed, and these are a year old, but they only give their rating once a year, ironically in July. And so the next time they give the credit rating, the X date would most likely have come, or it literally will be on the verge of coming. So they have given it the highest possible credit rating for both the FHLB and the FFCB. Then the question is, what could change that rating? Watch out. The first thing that the rating agencies say is, hey, if there is a debt downgrade of sovereign debt, then we will also downgrade FHLB and FFCB. And you know where that story is going. By the way, this is from fitchratings.com. You're welcome to read that paper. The second thing they are saying is if the support from the United States government to these agencies decreases, we will decrease the downgrade. Guess what will decrease the support? If the government cannot print money, hint, hint, possibly happening later in summer, if the government cannot print money, we will downgrade FHLB and FFCB. If there is a liquidity issue, we will again downgrade it. Again, something that could happen. The reality is all these three are likely to converge and happen in July 2023. And so if you own long-term FHLB, FFCB bonds, you're in trouble. In all likelihood, there will be a big blip in the middle of the year. Having said that, the 1 year poses a very different opportunity. Let's talk more. Let's say that there is a debt ceiling scare and a credit rating downgrade. The cost of borrowing will increase across the board. New bonds will be issued by FFCB and FHLB, but they will have to be issued at a much higher rate. I don't know the rate, but it could even be 6%. It could be more than 6%. The existing bonds are unlikely to be called only because you need money to buy back the existing bonds. And if you have a liquidity crunch, you don't have the money to buy those bonds. So what does it all mean? You have a very good opportunity to lock in a 1 year agency bond at that 5.25 before state tax or 5.6% in gross taxes before any taxes. And you can just sit on it for a year. It may drop in value only because of a credit downgrade in July. But if you just waited until another year, next April, for example, you get your par value back, and FFCB and FHLB are not going to go bankrupt. That's just not going to happen. So the risk of owning that is very low. You get the highest possible yield as of right now. So what happens when there is a debt default for agency bonds? Think again. What will most likely happen is the price of the bond, if you wanted to sell the bond, will crash. I personally am adding duration. I'm picking up some 1 year government agency bonds. I do not plan to sell them. I will just hold them to maturity. So even if the value, the trading value drops a year later, I'll get back my $100. If there is an equity crash, I would jump to equities, value investments. And there is a crazy move in July that could happen. Imagine that the credit rating of agencies drop. If the credit rating of agencies drop, what do you think will happen to the price of long-term bonds where FHLB and FFCB say will pay 5%, will pay 6%? Their prices will drop, which means their yields will jump like crazy. And so one possible thing is to sit in cash, which is why I personally want to have a very solid cash position in June, July. And if there is a credit rating issue for the government agencies, adding duration in June or July is likely to be a very positive thing to do. And it is also state tax exempt. And we'll talk about that when that date comes closer. Here is what it means to our proverbial ice cream, which is the short-term yields. We were celebrating how short-term yields were fantastic. That is under threat. And so because we don't have too many days between now and June 30th, give or take, The first thing is to watch how things go between now and June 1st. I personally am not adding anything past June 30th, except for agency bonds based on the strategy we discussed. And buying equity that is discretionary, meaning things that you don't have to have, would be, in my opinion, a poor choice. Buying things that you have to have is good, but even there, you may want to wait until June 30th or something like that, at least until June 1st to see how things are. Having said that, if you have any questions or comments, please email yieldnerd@gmail.com, and thank you for your support. Thank you for listening to Yield Nerd, a do-it-yourself show for yield accumulation and management.